JLL's recent Hong Kong Sevens client event, we caught up with some of our country leaders to hear from them how key real estate markets have been performing so far this year and what might be in store in the coming months.
The first quarter saw good economic growth. The commercial property market was strong, good take-up from corporate occupiers, and we saw office rents rising for the third quarter in a row. Lots of capital looking to invest in Singapore. It remains one of the most attractive markets in Asia at the moment, and we're continuing to see strong interest from overseas and local investors.
It's a very clear stated intention of the Chinese central government to control credit expansion right now, and that is certainly impacting the availability of liquidity to developers. This is a very challenging situation. I think it's been telegraphed fairly clearly, so the larger developers saw it coming. They were very active in 2013, issuing debt offshore and accumulating capital on their balance sheet. I think they're very well positioned to consolidate the industry because smaller local players are certainly feeling it most severely.
The entire first quarter of 2014, we haven't seen demand come in from the residential. The sentiment has been low. I believe once the elections are over and we have a stable, business-friendly government in place, we could see the real estate sector go up again. Having said that, we've seen in the first quarter of 2014 capital market players being pretty active. Investors like Blackstone, GIC, Brookfield have been active in the first quarter of 2014 and buying core assets. And given the prices of the offices today, they believe it's the right time for them to go in and just buy before the elections when the prices are at its trough.
Looking at first quarter of this year, it seems this trend continues. The domestic capital, for example, J-REITs are actively buying real estate. Also, we are seeing more interest from international investors. So we expect that transaction volume this year will grow by 20% plus compared to last year.
It's been a very busy first quarter with so much investment capital looking for a home, which will be accommodated. There are some very large assets that are currently on the market and being transacted, and we expect 2014 to be very strong. The leasing market was quite subdued in 2013. In fact, it was a record low year for take-up of office space, which is very interesting given it was a record year of investment activity. The leasing market has already started to improve, and 2014 will be better. But 2013 was difficult for three reasons. One, there was a very difficult political environment. That's now been sorted out. Two, there was the slowdown in the resources sector, so that impacted on lots of tenants. And thirdly, it was off the back of a record year for take-up in 2012. So naturally, it was going to slow down somewhat. So that cocktail of events meant it was a slow year in 2013, but 2014, whilst not strong, will certainly be stronger than 2013.
I think Central is still the most interesting location and the most attractive location for most of the major brands, in particular the major retailers. However, given the fact that the rents are being very high at the moment, I could see they are being less aggressive in bidding for rents these days. Although alternatively, they are looking for some other location, like along the public transport, along the railway, for major shopping malls, whereby people can shop comfortably without walking along the streets. And these are actually a new sort of option to the major retailers, which could compete with Central.